Good morning. It's Jeffrey Christian of CPM Group. It's about 10:30 in the morning on Tuesday, the 8th of April here in New York. I want to talk about a variety of things today. It'll be a little bit longish presentation. I want to talk about a few economic realities or inconsistencies in the way people think and some of the demagoguery that we're dealing with. I have a couple slides that I want to show you about the stock market chaos that we've been seeing, and then I'll talk about gold, silver, platinum, and palladium. So those people who think that I should only talk about gold, silver, platinum, palladium because I don't know anything about economics or the equity markets or the broader financial markets, they'll have plenty to complain about today. So that's my topics, a couple of economic realities, how to view the current stock market situation, and then updates on precious metals. Gold, for its part, is about $3,026 for the June contract as we speak. Silver is about $30.40. Platinum is $917, $918, and palladium is about $894. So a really mixed bag, which is what we've really seen over the last several trading days. This is off topic, but it's something that's an example that will maybe help you understand why I'm talking about what I'm talking about next. One of the top measures that we use, or that at least I use, to gauge whether someone is a legitimate analyst, an honest analyst, or is just a demagogue, is how they speak about the U.S. government's unfunded long-term liabilities. But you'll hear people talk about that. Usually gold promoters and gold true believers will say, you have these massive multi-trillion dollars, tens of trillions of dollars in unfunded long-term liabilities over the next 30 years, over the next 50 years. But the demagogues never mention projected U.S. government revenues over the same period of time. A legitimate analyst will look at both sides of the balance sheet, right? And say, okay, we have these unfunded liabilities. We don't necessarily have secure income, revenues that we can project, but we have a pretty good idea of what our revenues will be over time. And you look at both sides of the balance sheet, and those unfunded long-term liabilities are issues, they're problems. Social Security is not nearly the kind of problem that the demagogues would have you believe, but there are issues there. But if you put it into a balance sheet with reasonable projections of government revenues, all of a sudden those problems are much more manageable, or seem much more manageable. So speaking about only half of the government's balance sheet may be akin to using only one side of your brain. Yeah, we don't use half of our brain. We use a small portion of our brain. And I put this in here just so you know. A demagogue is defined, not by me, but by dictionaries, as a political leader or other person who seeks to support by appealing to the desires and fears and prejudices of ordinary people rather than using rational arguments. I try to avoid demagogues. Unfortunately, other people elect them. Now, the case at hand that I want to talk about are trade deficits. A similar marker distinguishing an analyst seeking an honest view of economic realities and a demagogue is whether the person speaks only about the U.S. trade imbalances and never discusses where all that money goes to that the U.S. ships abroad. I mean, U.S. consumers buy foreign goods, U.S. corporations buy foreign goods. I think every hospital bed in America is made in the Czech Republic, for example. We don't make them. No one else does, actually. It's something that they have a competitive advantage on, and they produce hospital beds for the world. Corporations, the government, consumers buy things overseas, they pay for them in dollars, and there's this massive amount of dollars that goes over it. That's the trade imbalance. The question is, where do all those dollars go? And the reality is that most of it comes back into the U.S. as investments. Those investments finance economic growth in the United States and U.S. Treasury securities that finance the government's excessive deficit spending. At the end of June 2024, the period for which most recent data is available, foreign entities were measured to own $31.3 trillion in U.S. assets. I'm not quite sure if this includes real estate and farmland. Of it, 17 trillion was in U.S. equities and 13 trillion was in government and private debt. Of that 13 trillion, 8.2 trillion was U.S. Treasury debt that was held by foreign and international investors. And it's very important to understand that term, foreign and international investors. I'll talk about that in a second. In other words, foreigners are investing our trade imbalances in the U.S. That helps the U.S. economy, and it helps support U.S. government deficit spending, which keeps the whole ball of wax going. Decades ago, I was in Hawaii at a resort that had recently been sold by the Rockefeller family interests to a Japanese company. And some of the people who were working at this hotel, beach resort, were kind of upset that a Japanese company had bought their hotel. And I asked them, I said, well, why do you care who owns this? And, quite frankly, you get more Japanese tourists because it was a honeymoon destination for Japanese couples. You get a lot more business from Japan than you do from the Rockefellers or from New York even. And what does it really matter to you? The reality is that if foreigners are investing in U.S. corporations or farmland or real estate, the real estate's a problem because they drive the price up. But in terms of them investing in corporations, that's good for us. And what are they going to do? Come and take the factories? Are they going to take the farmland? It's not so bad. It's worse in a way that they are financing our deficit spending, reducing the discipline that Congress and the administration needs to have. Now, let's talk about those foreigners, because that's a real quickie things. The Treasury doesn't know exactly who owns this U.S. Treasury securities, except insofar as some governments and other organizations will tell them or will report it in their own financial statements, and you can call it. Most of this is not owned by governments. Most of it's owned by individuals. Perhaps 30% or more of these international investments come from U.S. corporations and pension funds and wealthy individuals that shield their income from U.S. taxes by holding some of their wealth offshore. And by holding it in U.S. treasuries, they don't have to worry about holding it in some other currency that might depreciate. So they have a currency hedge, a dollar hedge. They're protected against a different currency declining by holding this offshore in treasuries. So when we talk about the $8.8 trillion or whatever it is that's held by foreign and international investors, some portion of that is the U.S. I have here the example of Apple's Irish affiliate. Apple years ago signed a decades-long tax holiday with the Irish government and established an office there. That office, I don't know if it still does, buys Apple iPhones and computers from manufacturers in China, in other Asian countries around the world. And then they sell them. They buy them for, 20 years ago, I think it was like $1 per iPhone. It's probably like $10 per iPhone now. And then they sell them to the United States, Apple, for $1,000. U.S. Apple sells them to consumers, and they make $1 or $10 a phone profit. Most of the profit stays in Ireland, where it's not taxed. It's not taxed by the Irish government because of the tax holiday, and it's not taxed in the United States. Apple Ireland then invests in building factories in the United States. So that's foreign investments in U.S. corporations. And insofar as it has enormous amounts of money offshore, it doesn't. It puts it in treasuries, so it doesn't have to worry about currency fluctuations. So it's a lot more complex than the demagogues would have you believe. A couple charts here. I'm tired. I was looking for an older chart that we have that goes back into like the 50s. I'm tired of people saying the U.S. doesn't make anything anymore. This is the dollar value, which is really the only way to measure a diverse set of manufactured products, the value. This is the gross output of U.S. manufacturing. You can see it's about $7.2 trillion a year and has been for the last 3 or 4 years since 2022. That's, I guess, 3 years so far. It's been around $7.2 trillion. That's 50% greater than it was in 20 years ago. And it's about 30% greater than it was during the Trump administration, if you exclude the fact that manufactured output value plunged during the COVID lockdown in 2020. But prior to the COVID lockdown, in the first 3 years of his administration, it was about 30% less. The U.S. manufactures a tremendous amount of things, and they manufacture more than they did in the past 20 years. And then I had this chart going back several decades where it was an even more dramatic increase. I was looking for that chart, and I found this one instead. This is U.S. manufacturing jobs and merchandise trade balance. You see, the United States is making a lot more stuff, but it's making it with far fewer employees. The blue line is U.S. manufacturing employment, and this goes back really to the 1930s. You see the big surge during World War II, and then a steady growth in the late 40s, 50s, 60s, into the 70s, peaking in the 70s, even though we had this tremendous economic volatility, 4 recessions in 14 years. The blue line then starts to fall in the 1980s. The red line is the U.S. balance of merchandise trade balance. And you can see it was slightly positive in the 60s and most of the 70s, started to deteriorate a little bit in the 70s as financial and economic deregulation started growing, and other countries started economically developing more rapidly. But then U.S. merchandise trade balance fell sharply from the 80s into the present. Now, this only goes through 2012, and I apologize, I didn't update it. I was looking for the other chart to drop in here at the last minute, and I didn't find it, but I found this. So we've got increasing manufactured output, increasingly computer assisted and now computer driven and manufactured. And we have fewer jobs. And we have a decrease in employment in the manufacturing of those goods. So we have offshore goods. There are estimates that we've lost more jobs to computerization than we have to jobs being shipped overseas. But what we saw was that the tax code was changed in the early 1980s to make it advantageous for companies to export jobs. You don't own a company in China or Malaysia. You have an affiliated company that you're related to that does your manufacturing for you. We were looking at the cotton industry in the southeastern part of the United States 20 years ago. And what we found were that there were cotton mills that kept saying, hey, we have to do something about the fact that manufacturing weaving into cotton cloth and then manufacturing cotton clothing and products was going offshore. And other mills were resisting any government efforts to do that because they had already signed up with affiliated companies throughout Asia to do their manufacturing at a fraction of the price, and they didn't have to deal with American workers and American costs and American unions, et cetera, et cetera, et cetera. So the whole issue is a lot more complex than the demagogues would have you believe. Another example is iron ore. The U.S. iron ore production is around 44 million metric tons in 2023. Iron ore use in the United States was around 36 metric tons. You do the math, that's about 8 million ounces more iron ore being produced than is being used in the United States per year. We produce more iron than we use. We export the difference. In 2023, the year for which we have full data, gross exports were about 11 million metric tons. Gross imports were about 3.5 million metric tons. And the net exports were about 7.6 million metric tons. In other words, the U.S. iron ore industry is heavily dependent on foreign markets to take off its surplus iron ore production. The U.S. has more iron ore, it produces more iron ore year in, year out than it uses. It needs to export the iron ore. So the problems that are plaguing the U.S. iron and steel industries are domestically generated. Tariffs won't help solve them, but tariffs will disrupt the U.S. trade in iron ore as other countries retaliate and say, you're putting tariffs on our iron ore exports to you. We'll put tariffs on your iron ore exports to us. We won't ship you that 3.5 million metric tons of iron. We won't buy it from you. We won't ship it to you. We'll use it to displace some of the 11.1 million metric tons of iron ore that we have been buying from you. So tariffs won't help solve the iron and steel industry problems because foreign trade is not what's causing them. But tariffs will hurt U.S. producers of iron because of it. Again, the demagogues just tell you the wrong things. Now, two charts about the stock market. This is the S&P 500, and this is the kind of chart you see in the Wall Street Journal and the New York Times and on the evening news and elsewhere. And you can see this massive plunge in the S&P over the last really couple weeks, right? Tariff-induced decline in the S&P. And you can see it's all the way back down to where it was a year ago. It's actually up today. This is a little bit calmer view. Yeah, we've just lost a significant amount of stock market value. But if you're a retiree and you retired, say, 5 years ago, when the S&P, before the COVID lockdown, the S&P was around 5,000, a little over 5,000. Got up to 60, it got over 6,000, and now it's back down to about 5,000. I'm sorry, it was around 3,000. Got up to 6,000 and more than doubled over the last 5 years. Now it's back down to 5,000. You're still better off than you were at any point in terms of if you have your retirement funds in the stock market. You are still better off than you were at any point prior to April of 2024. So yeah, it's problematic. It's very worrisome, but let's put it into perspective. Now, speaking of putting things into perspective, here's gold. Gold prices got to $3,200 an ounce last week. And now it's $3,026 an ounce. It has given up $200. CPM Group, in our gold trade recommendations that we sell to some clients and also make available for free on Kitco, have been saying, okay, we thought that the price could fall maybe to $3,000. It actually has fallen below that. It got down to the low today was $2,993, according to the CME. For the June contract. It got lower yesterday. CPM Group has been saying that we think the range for the next month could be 2,850. So that's another 150, 170 points, dollars lower, but also 3,200. We think it could go back and actually break above 3,200 over the next month or so. And over the next 3 months, we say, look, We wouldn't even be surprised to see the price get as low as $2,660. That's where it started the year on a brief temporary basis. Our expectation is still that the gold price will rise, and we're telling our clients stay long, not necessarily buy at 3,200, maybe buy some puts to protect yourself from $200 declines in 3 days, but stay long because we think that the gold price still has further to rise. But in the meantime, over the next 6 months or so, you could see some weakness that could take the price down as low as $2,600. I mean, it's hard to say how low or how high prices could go in a spike that is produced or induced by macroeconomic and political developments, which is what we're looking at. We're looking at a volatile world that is going to cause the gold price to rise, but also to be much more volatile. Silver's a little bit different because April is an active delivery month for gold, and that delivery process is largely behind the gold market. Silver still has May to come. So over the course of April, you'll see companies and other entities that are short the May silver COMEX futures contract buy those shorts back and then sell forward into July and roll their position forward. And they do that because that position is a price hedge of their long physical position. There are no banks in the world that have naked short positions on the COMEX, nor are there any banks that have long physical silver positions that are not hedged. They can't afford that price volatility. We talked about this in last week's video, and there were some very good comments where somebody actually explained this to people who said, I don't understand it. But that's what's happening. So you keep rolling your hedge forward because you continue to own a lot of physical silver. That's what commercial traders do. They provide the financing for the mines, the smelters, the refiners, the fabricators, the wholesalers, the retailers. And they do that with physical metal, and they get paid a fee for doing that. And then they protect themselves against price moves by hedging their long physical positions with futures. And I'm sorry if some people can't understand that, and I'm sorry if some people refuse to understand it, and I'm sorry that there are promoters out there who continue to promote dishonest representations of this, even though they've had it explained to them numerous times. But gold and silver will always have grifters in them. That's what people do. And gold and silver will always have people who will believe the grifters and ignore any rational thought. That's why demagogues rule the world. Now, at the end of March, we had 619 million ounces of open interest in the May contract. That's down to 530 million ounces. Still very large, has to continue to decline, and it will decline over the course of April. Most of that will disappear. We're less than a third of the way through April right now, and we've already seen 80 million ounces of it roll into the July contract. There's about 10 million ounces that's been delivered, but most of it is still in the July. Most of it is getting rolled into the July contract. At the end of March, July had 152 million ounces of open interest. It's now at 231 million ounces. So you've seen about an 80 million ounce decline in the May open interest and about an 80 million ounce increase in the July contract. That will continue to happen. That roll, if you're short May, you have three things that you can do. You wait until May and deliver into it. You can buy it back. Just buy it back, close out your short position, or you can buy it back and sell simultaneously in July and roll your position forward. If you're a hedger, you're going to roll your position forward. If you're a speculator or something else, you might close it out or you might deliver it. Right? That's what's happening. And that's going to help support the price of silver, we think, over the next 3 weeks. Silver prices got as high as $35 an ounce in the nearby active contract a couple weeks ago. It has coughed up a lot of that. It got down as low as $29.80 this morning. It got even lower, below $28 yesterday and the day before. Our view had been that $28.50 might be support for silver over the near term. Obviously, we were wrong because the price has gone lower. It's now back up to $30.48, 40 cents right now. Our view had been that the price would find a base around $28.50. Obviously, the price has gone lower. It could go a little bit lower. You can see some technical support around 28, another technical support around 26.50. Our longer term view is still that we think the silver price will rise over the course of 2025 into 2026, maybe even into 2027. But in the near term, you do have this downside exposure. And silver is a more volatile metal price-wise than gold because it's a much smaller market with less dollar value and such. Our view for platinum has been that the price would trade between 850 and 1,050. That's the range that has really held for a couple years now, and our expectation is that it will continue to be in that. Late last week, we thought that the platinum price would probably rise. It was trading at probably around $950, $960 at the time. We thought it would rise toward the higher end of that range, 1,000 or 1,020. It did not. It fell and is now at the low end of that range. It got down to below $900. It's trading a little bit above $900 now. Our expectation is that range is going to continue. We wouldn't be surprised to see the price rise back into that range from where it has been touching the low end of the range that we've seen really for several years. Platinum and palladium both suffer from the fact that their major uses are in the auto industry. The auto industry already was facing tough times. It's losing petroleum-powered vehicles are losing market share to electric vehicles. Demographics are shifting away from people buying as many cars as they used to. The auto industry was suffering already. The potential for the tariffs and the potential for a recession make the auto industry even more likely to see lower production and sales, which means that they'll be using less platinum and palladium, which means that the prices will probably stay low. We also expected the palladium price to trade in this range of, say, 850 to 1,050 or maybe 1,100. And we had thought that the price was more likely to rise last week than fall, and instead it has fallen. And our expectation is that now that it's at the bottom end or toward the bottom end of its trading range, our expectation is that it will rise a little bit more. That's all I have for you today. You can go to our website. You can buy our gold yearbook, which came out in late March. We are working on our silver yearbook, which will release in late May. The precious metals and our platinum group metals book will come out in late July. Precious metals markets, as I said, will always have those demagogues and hucksters hawking metal and trying to instill fear and concern, and the world's going to end, and the economic world is going to be reset, and just all kinds of stuff that just doesn't happen. And if you stop and maybe take a walk or have a cup of decaf tea, and think about it and say, okay, this guy has been saying this to me for years and he's been wrong. Why do I continue to listen to him? Why do I continue to worry about these things that haven't happened for years and years to come? So just Look at somebody's track record and invest in the people and listen to the people who have been right. Don't listen to the people who clearly don't know basic economics, let alone the dynamics of the precious metals markets. You can buy our gold yearbook. The last page will tell you how to take it to a copy shop as a PDF and have it printed if you want a printed and bound copy. You can go to our website. You can pre-order the silver and platinum yearbooks. You can order the gold yearbook. You can buy other research that we produce. There's a lot of free reads and videos there. And you can send us a note at info@CPM Group about our retail investor program, which is a lower priced way to access our research and our analysis than some of the more expensive services that we offer corporations and institutional investors. Take care of yourself, take care of those around you, try to do something good for the world, and be very skeptical about what you're hearing in the world, because a lot of people are probably getting it wrong. Take care. We'll talk to you later in the week.